Individual stocks versus index funds. Which investment strategy is best for you? When it comes to investing, there is no one-size-fits-all strategy. The type of investment strategy you choose should depend on a variety of factors, such as your risk tolerance and financial goals. In this video, we'll explore the pros and cons of two popular investment strategies, individual stocks and index funds, to help you determine which one is best for you. What are index funds? Index funds are a type of mutual fund or exchange-traded fund, ETF, that tracks a specific index, such as the S&P 500. The fund invests in the same stocks that are included in the index, so the fund's performance is closely tied to the index's performance. When it comes to investing in index funds, there are two main types you'll come across: broad and concentrated. A broad index fund invests in a diverse range of assets, such as the S&P 500, which tracks 500 large-cap U.S. stocks. A concentrated index fund, on the other hand, focuses on a smaller number of assets, such as a single industry or sector, like technology. The key difference between these two types of funds is the level of diversification. A broad index fund provides exposure to a wide range of assets, which helps to spread out risk. This means that if one sector or company performs poorly, the impact on your overall portfolio is likely to be minimal. In contrast, a concentrated index fund is more reliant on the performance of a smaller number of assets, which can lead to greater volatility. Concentrated index funds can offer potentially higher returns than broad funds. By focusing on a particular sector or industry that is expected to grow, you may be able to achieve greater returns than you would with a broad fund that is more diversified. Ultimately, the choice between a broad or concentrated index fund comes down to your investment goals and risk tolerance. If you're looking for a safer, more conservative approach to investing, a broad index fund is likely the better option. If you're willing to take on more risk in pursuit of potentially higher returns, a concentrated index fund may be worth considering. Index funds offer a diversified investment option, as they invest in a broad range of stocks across different sectors and industries. This diversification reduces the risk of significant losses from any one company or industry. Index funds also typically have low expense ratios and require less maintenance than actively managed funds or individual stocks. This makes them an attractive investment option for those who want to minimize fees and reduce the time and effort required to manage their investments. Overall, index funds provide a low-cost, diversified investment option that can offer steady returns over the long term. What are individual stocks? Individual stocks are shares of a single company that investors can purchase in the stock market. When you buy an individual stock, you're essentially buying a piece of ownership in that company, which can potentially lead to profits or losses. There are thousands of individual stocks available for investment in the stock market. Each company has its own unique financial situation, industry sector, and level of risk associated with its stock. Some examples of well-known individual stocks include Apple, Amazon, Google, and Coca-Cola. Investing in individual stocks requires a significant amount of research and analysis to make informed decisions. Investors must take into account factors such as the company's financial performance, leadership, industry trends, and competitive landscape. While investing in individual stocks can be rewarding, it can also be very risky. Stocks can be subject to sudden market changes, unexpected financial issues, and other unforeseen events that can cause the stock's value to fluctuate significantly. Investors need to diversify their portfolios and not rely too heavily on any single individual stock. The pros and cons of each investment strategy. Before making a decision about whether to invest in individual stocks or index funds, it's important to weigh the pros and cons of each strategy. Potential for high returns. If you pick the right individual stocks, you could see significant returns on your investment. Flexibility. You have the ability to choose which specific stocks to invest in based on your personal preferences and investment goals. Control. As an investor in individual stocks, you have more control over your investments, including when to buy and sell. Higher risk. Investing in individual stocks comes with a higher level of risk. If you pick the wrong stock or if the company underperforms, you could see a significant loss in your investment. Requires research and expertise. To invest in individual stocks successfully, you need to have a strong understanding of the stock market and the companies you're investing in. Higher fees. When investing in individual stocks, you may incur higher fees, including trading fees and fees for research. Diversification. Index funds are a diversified investment option, meaning you invest in a group of stocks rather than a single stock. This reduces your overall risk of loss. Lower fees. Index funds generally have lower fees than individual stocks, making them a more affordable investment option. Passive investing. Index funds require less research and monitoring than individual stocks, making them a more passive investment option. Lower potential returns. While index funds may provide steady returns over time, they are unlikely to see the same high returns as individual stocks that outperform the market. Limited control. As an investor in index funds, you have less control over which specific stocks you're investing in. Lack of excitement. For some investors, investing in index funds may lack the excitement and potential for high returns that come with investing in individual stocks. Index funds offer excellent compounding benefits if you hold them for a long time. So, which investment strategy should you choose? Choosing between investing in individual stocks and index funds can be a difficult decision. Both strategies come with their own set of advantages and disadvantages, and the best option for you ultimately depends on your financial goals, risk tolerance, and investment experience. If you are just starting to invest and is looking for a low-risk, low-cost way to build wealth over time, then index funds might be the right choice for you. With an index fund, you can diversify your portfolio across many different companies and industries without having to worry about individual stock picks or research. Additionally, index funds tend to have lower fees and are typically more tax efficient than individual stocks. On the other hand, if you have more investment experience and are willing to take on higher levels of risk for the potential of higher returns, then investing in individual stocks might be the right choice for you. By picking individual stocks, you have the potential to beat the market and outperform index funds. However, this requires a lot of research and knowledge about individual companies and industries. You also need to be willing to accept the potential for higher volatility and the possibility of significant losses. Ultimately, the choice between individual stocks and index funds comes down to your personal preferences and goals. It's important to consider factors such as your investment experience, risk tolerance, and time horizon before deciding. A good strategy may be to diversify your portfolio between both individual stocks and index funds to balance out the potential risks and rewards of each strategy. Consult with a financial advisor if you're unsure which option is right for you. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.